Alright, I'm come up with one more video on the RBI monetary policies. As we know, last week the RBI has announced their new RBI policies and the repo rate has been changed. So today I'm come up with the new video where we can talk about what are the RBI new monetary policies and how it is going to affect our pocket. Alright, moving to the next slide, let me just introduce myself. I am Sukhdeep Singh. I think most of the people they know. Right, I'm Sukhdeep Singh. I'm an alumni of IIM Calcutta. I work with multinational companies like TVS Motor Company, BMW, Tata Motors and ITC. And I know you guys wanted to know why I'm talking on this topic. Yes, obvious reason, I love finance. So moving to the next slide, let me set the context for our today's discussion. So I will today discuss more about on the RBI policies. Right, so moving ahead, I will talk about what are the key outcome of the RBI policies from the last meeting, right? And the second, I will talk about the RBI policies, how it is going to affect, right? And the third but not the least, the impact of this RBI policy on the interest rate for FD and as well on the loan. So from last 3 meetings, I have consolidated all the data in one slide. You can see that from May to August, almost 140 basic point has been increased. So for example, the repo rate in the month of May was 4%. Now it has been increased to 5.40%. So the meaning of that is almost 140 basic point has been increased in the repo rate. It means the loan become more costlier. So in next slides, I will give you more example on that how our EMIs will be increased and what impact will give to our EMIs and with the increase of this repo rate. So from last 3 meetings, I have consolidated all the data in one slide. You can see that from May to August, almost 140 basic point has been increased. So for example, the repo rate in the month of May was 4%. Now it has been increased to 5.40%. So the meaning of that is almost 140 basic point has been increased in the repo rate. It means the loan become more costlier. So in next slides, I will give you more example on that how our EMIs will be increased and what impact will give to our EMIs and with the increase of this repo rate. Before moving ahead, let me just set the context and give you more insight about what is repo rate. Repo rate is a rate at which RBI lends money to the banks, all the commercial banks I am talking about. So whenever they can lend any money to the banks at some rate that is known as repo rate. So whenever there is an increase of repo rate, it means there is less liquidity in the market, less movement of money, less people have money to buy more things. So it means there would be less economic activities in nutshell. It impact everyone and decreasing inflation, because when we don't have money to buy products, it means there would not be any economic activities. If there would not be any economic activity, it means reduce. The major objective of monetary policies is ensure that there should be control of inflation, economic growth and the third, exchange rate stability. There are many things for which this monetary policy has been made, but these are 3 major things for which this policy has been made. So moving ahead, we can understand what's the inflation rate in India right now. I have made the comparison between 2018 rate, 2020 rate and 2022 rate so that we can make the comparison why there is a need to increase the repo rate. So we can start with the understanding of 2018. The inflation rate was at 5.10 in the month of January and likewise 4.40 in February, and it has been decreased to 4.30 in the month of March. Likewise, it has been decreased in the month of October, November, December, and the annually the average rate inflation rate was 3.90. So this is where you need to understand. And second thing was in the month of 2020, the inflation was at peak in it is almost 10.60 in the month of January because of pandemic. We have just coming out from the pandemic, lot of like economic activities are happening, and there is a Ukraine and Russia war which is impacting across the world. So we can also that understand in next video what is the impact of Ukraine and Russia war on Indian economy. So if you can see in 2020 it has been increased, whereas afterward it was on the declining trend in the month of March, and again it picked up and again it has been declined, and over the months of last half yearly it increased and decreased. So average out was in the 2020 it was 6.60, whereas in 2022 it has been increased from 6% to 7.80, and again it is remain on the upper side of 6%. So as per economists, if the inflation remain within the limit of 4 to 5%, it is inevitable. So there should not be worrisome situation, whereas if the inflation goes up more than 4 to 5%, then their RBI and the government needs to take the preventive action, so it should not be out of control situation. So this is why, this is the reason RBI has increased their repo rate. There should be less liquidity in the market, and there should be less commodity price hike, and the people have less buying power, and it reduces the consumption. So overall consumption reduces and the prices goes down. So this is the reason why the RBI has increased the repo rate. I believe this picture speaks 1,000 words of inflation. Before inflation, if you are getting some burger at $4.99 for 5 layers, after inflation I think we are getting at the same price just 1 layer of burger. I think this one picture depict what is the meaning of inflation. So now we can understand the impact of repo rate increase on the EMIs, because ultimately it is impacting our pocket. From this we can try to understand the impact of repo rate increase on the home loan. For example, if we have taken 30 lakh of home loan, right, for the tenure of 20 years and the interest rate 7.55% before repo rate increase, the monthly EMI we were paying around 24,260, and principal amount remained 30 lakhs. Total interest being paid with the same EMI if there is no increase in the interest rate, then we were paying around 28,22,304 the interest rate, and the total amount comes out to be 58,22,304. This is before the increase of repo rate. Now in next slide we can understand what's the impacts come out. Just the increase of 0.5 basic point repo rate. Same loan amount we have taken 30 lakhs and the tenure remains 20 years. Interest rate 50 basic point, just I have taken the 50 basic point for repo rate increase, and here also the EMI comes out to be 25,187, whereas before repo rate increase it was 24,260, and now it's come out to be 25,187. Almost 1,000 rupees we need to shell out more month on month, and before we were paying 28 lakhs approximately, now we have to pay 30 lakhs. It means 2 lakhs more we have to shell out by just 0.5 basic point increase of repo rate, and this is what the impacts come out. So total, earlier we were paying 58 lakhs, now we have to pay 60 lakhs. So almost 2 lakhs we have to pay more by just increase of 0.5 basic point in repo rate. This is the impact. This is what we wanted to tell you. If they say increase of repo rate, it impacts the EMI. There would be a less people who can take the home loan at this price point. Less economic activities, less circulation of money in the market, less liquidity. So this is the impacts come out to be whenever we increase the repo rate. Alright, now we can understand the impact of repo rate on the fixed deposits. For example, if we invested 30 lakhs for 1 month's time, right? I just wanted to compare apple to apple. So rate of interest remains 7.5% I have taken, and monthly we are getting 18,000 rate of interest, right? After maturity of 30 days, we'll get 30 lakhs 80,000, right? This is before the repo rate increase. Now we can see with the 0.5 basic point increase what the fixed deposit amount will get after 1 month's time. So same 30 lakhs I have taken, 8% rate of interest, right, for the tenure of 1 month. Earlier we were getting 18,000, now we are getting 19,200, almost 1200 rupees will get more amount. So the total value comes out to be 30 lakh 19,200. So it means home loans will get costlier, whereas on the fixed deposit you will get more return, right, because there is an increase of rate of interest. Earlier we were paying 7.5%, now the banks are paying 8%. Now we can summarize whatever discussion happened in today's video. As we have seen, there is an increase of the repo rate and it impacts the economic activities, slow down the economic activities, as well as increase in the EMI, increase in the FD rate of interest, reduce the circulation of the money in the market. So it means less liquidity in the market. Apart from that, we have talked about the stability of pricing. So for stability of pricing, RBI time to time bring the new RBI policies so they can ensure that there is a less inflation in the market, right, more liquidity in the market, and good amount of economic activities happen. Apart from that, inflation and many people below poverty line. That's the crux of our today's discussion. If there is an increase of inflation, it means people become more poor, they go below the poverty line. That's all right. Thank you. Thanks for watching my video, and please do subscribe to my channel, write comments below.